the whole fiat monetary experiment's dying on its feet, and the idea that somehow the dollar is worth more than the yen and the pound, etc., and the euro is just farcical.
Monaco 64, home of alternative economics and contrarian views. This interview is being conducted on Thursday, May 5th, 2022. Have the pleasure of speaking with Paul from the Sirius Report. I recommend, if you haven't yet, to go to his blog, thesiriusreport.com. Paul does no-nonsense, truthful analysis of geopolitics and economics, and I highly recommend his premium content, which basically you get 5 podcasts or episodes a week for $1 a week, which seems really good value. Paul's background is in the city of London, a bit like me. Prior to that, I think he was more in academia. And yeah, it's always great to have you on, Paul. How are you?
Yes, thanks, Mario. Thanks for the very kind introduction. Yes, I'm fine. We're back from the Netherlands, and my advice is if you're living in the Netherlands, your internet speeds and reliability is not as great as it is in the UK. We had all manner of problems trying to do things well with us. So whilst it's not nice to be back from a family perspective, it's good to be back from an internet perspective and trying to record things and do interviews or whatever.
That's good. We talked about what we were gonna cover today, and I wanted to cover like the prospect of maybe Chinese sanctions, the West imposing Chinese sanctions on the Chinese, that is. But we've also seen a lot of events as it pertains to the US economy, the Federal Reserve, the UK economy, and the Bank of England. So before we go into China and the prospects or the possibility of sanctions, maybe you could talk to us what you think is happening in terms of the Fed, the economy there, and also the UK. I mean, we raised rates today, the Bank of England, by, like you said, a puny 25 basis points when the RPI, which is the broader measure, inflation, is growing at almost 10%. I mean, it's meaningless. And we've seen the British pound drop like over 250 pips, which is pretty big. And we're seeing the gold price in pounds almost reach, well, close to the previous all-time highs, around 1560 or 70. So I'll let you take it away now, Paul.
Yeah, I mean, let's start with obviously the Fed announcement yesterday, and it was widely predicted they'd raise, interest rates 50 basis points or 0.5%. But as we all know, and you've said it, I've said it, in reality, it's completely meaningless because official inflation is running at 8.5%. In reality, it's somewhere between about 18 and 22%. So even if they raised interest rates to 3%, 4%, 5%, it would still be pretty meaningless. But of course, they're not going to do that. And I think at this point, it's probably not wise to try and comment on what the reaction is going to be. I think we more have to look at it and say, okay, let's see what happens in the coming days, weeks, and until the next FOMC meeting, where again, there's an anticipation they'll raise rates 0.5% again, or 50 basis points, and maybe the meeting after that the same. So we could be looking in several months where, US interest rates could be 1.5% or whatever to 2%, depending if they actually raise them. And that's a debatable issue in of itself because we have to see what the impact's going to be. Now, what's very obvious in terms of what the impact's going to be, if you raise interest rates, then that's going to curb people's spending because they're going to have less disposable income, never mind the fact of because so much of Western society is so heavily indebted. in terms of not just mortgage debt, but credit card debt and other loans, etc. Now, okay, if you've got a fixed rate loan, that's fine. But if you've got variable rate mortgage or credit cards with variable interest rates, then you might start to be in a bit of trouble. Never mind, as we said, price inflation in terms of food and energy. The other problem you will have with regards to raising interest rates is because the Western economies are just built on credit. As we saw when we had the pandemic in March 2020, it was self-evident they had to bail everything and everyone out, to the tune of trillions of dollars to prevent in the US and correspondingly bailing out Europe and the UK. I separate them because Britain's not part of the European Union now. Because without that, everything would have collapsed. So the logical argument is if you start raising interest rates, then and you're so heavily dependent on endless credit, then you're going to have to pay more to get more credit, and businesses are already struggling. But when you start to raise interest rates, then the risk is they're not going to be able to meet their repayments in the future, and never mind their businesses are suffering because of inflationary pressure, which is affects if you have massive inflation in energy terms, excuse me, then that affects every facet of your economy. For obvious reasons, because everything depends on energy. So there are a lot of ramifications that will come to pass in the coming weeks and months. And at this point, we can't ascertain what they'll be. But the obvious thing is this is going to hit the bottom line of every business to varying degrees. So the logical argument we should see is equities getting hammered eventually, particularly if they keep doing this. And okay, bizarrely, I don't know what the Dow was up over 900 points in the end, but bearing in mind, all markets are completely manipulated anyway, but it's down about 0.7% the Dow today. The logical argument is, and logic rarely applies in this economic financial world since 2008, but we should expect to see equities hit. Now, the other argument will be what happens to the bond markets, particularly at the long end. So the 10-year. The logical argument would be if you keep raising interest rates, then it should be a dump at the long end. Because why would you want to keep holding treasuries on the basis that they may keep raising interest rates and also what's going to happen to the inflation pressure? Because in reality, I think even Powell came out and admitted the problem is the supply end in terms of inflation, which of course they have no control over. So the question is, what happens to the price of commodities? What's happening to the price of energy? And given the US, as we said before, is heavily dependent on its imports because it's as opposed to exports, hence running an enormous trade deficit of 110 billion, nearly a record high. So there are all these things that factor in what happens to the bond markets. And I mean, we've seen this huge rise and almost flattening of the yield curve from 1 year through to the 30-year. Do we expect to see people bailing out of the 10-year and moving into T-bills? Maybe, maybe not. We don't know, because that's far more short-term, like 1 month, for example. But why would they necessarily do that? And we've got to factor in that it's very clear that the world on a sovereign basis has been dumping treasuries to significant degrees. Will they continue to hold them? And this is primarily driven by the fact of the US sanctioning the Russian central bank, because everyone's looking at it going, we could be next. If we upset the Americans, then maybe they'll sanction our central bank or cut us off from SWIFT. So that's another reason there's no incentive for a large part of the world to want to hold US dollars or US treasuries. Now, dumping them or dumping dollars is not as easy as it necessarily seems. I mean, even the Russians went through a sort of long concerted plan to get off holding treasuries as one example, but they didn't do it overnight. So there are many factors in this equation, but the logical argument would be, I think, and some people would disagree, I think this will be a positive for gold and silver, but again, the argument how much are they going to keep trying to manipulate gold and silver? But what I think was very clear, I think we've seen, what was it, 11 successive trading days of silver getting hammered. And it got nearly down to $22 an ounce. It's now back over 23. And obviously, correspondingly, we saw the gold price move south. Was it 1865? It might be even lower. I don't track.
Yeah, I think it was
silver price.
Was 1850 the low in gold.
Oh, okay.
Days
right.
ago. And silver,
and
silver has rebounded quite well, I think, from those lows.
But I think the purpose of doing that was because if they hadn't done that, I think there would have still been this positive reaction since announcing they were raising interest rates 0.5% in both gold and silver. And there are people who disagree, but I actually think this could well be a positive for gold and silver, because for me, in the end of the day, we're not there yet. But there comes a point where you're in this kind of financial cycle where confidence in the dollar's waning internationally. That's absolutely true. Confidence in US dollars, US treasuries, and there comes a point eventually where are they going to put their money? Where do they trust? They're going to trust equities? No, and increasingly, I think, less so. They're going to trust the bond markets? No. So we're not there, but at some point there'll be an enormous demand for gold and silver. Now, and I'm not just talking about ETFs, I'm talking about physical gold and silver. Now, are we there at this point? I don't know. And I've always made the point, the real rises in gold particularly, but by correspondingly silver, comes about when the West effectively drained a physical metal. Not literally, but in the sense that it no longer can manipulate the paper price, because as I've tweeted before, and I tweeted yesterday, there's a world of difference between what people perceive to be the price of gold and the gold price. They're very, very different things. If you want to go and buy a ton of gold, good luck in how long it'll take you to source it and the price you'll pay. You certainly won't be paying 1906 or even 2006 currently to get a ton of gold. That's absolutely the case, because I know people involved in those markets. So it's one of those things, it's kind of a bit of a holding pattern. It remains, we have to sort of see, I think, in the coming days and weeks, what the ramifications are. There's always a bit of a knee-jerk reaction, and sometimes when they raise interest rates, the markets rise for a few days, but then they kind of hit a kind of not a high, but a high, and then they start falling. But we may find the reactions more extreme, because there's no doubt about it, when you have an economy such in the US that's completely dependent on credit, and a lot of times completely unjustified, where you're just bailing out failed businesses. Well, when you start to raise interest rates and we have inflation, it's going to hit the bottom line everywhere. So that's going to start to impact all equities, because people will start to go, hang on, I'm not sure about the valuations of these companies. So that's something you would expect to happen. But am I recommending people short the Dow or something? No, I'm not. We don't do true investment advice. I'm just saying that's the logical conclusion. But whether logic is something we perceive to happen in the future remains to be seen. But they'll be under enormous pressure to raise interest rates again. And I think, from my perspective, I don't think the Fed really understands what's causing the inflation. I mean, they're talking about the economy overheating, because that's always a perception that it's called the inflation's rising because of an overheating economy. And then we're told, hang on, GDP's fallen, and they're admitting it 1.4% in Q1. In reality, it's be considerably greater than that, because rather like underreporting inflation, they always either overreport GDP, or in the case of negative print, they'll underestimate how negative it actually is. So these things don't correlate. They don't understand the issue of commodities and the lack of access to commodities. They don't understand supply chain problems that are existing, what the sanctions on Russia are doing in a far broader context. And also, of course, with regards to raising interest rates, what does it do structurally inside the financial system? What's it going to do to the derivatives markets? And interest rate swaps account for an enormous percentage of derivatives. What does raising interest rates do to them? And they're trying to juggle a whole bunch of different kind of problems, not least trying to keep the price of oil below 120, 130 a barrel in dollar terms. Because if it stays above that, it will also likely blow up the derivatives market. So they're having to manage a lot of things to try and prevent this acceleration or implosion that we've long since talked about. And raising interest rates is something they never wanted to do. And they genuinely never thought it was a problem, because since 2008, they'd effectively, from their perspective, kept a cap on inflation, even though inflation existed, because it was in all these asset bubbles. But once the pandemic happened and they started printing huge amounts of money, and which were ending up in the real economy, coupled with all the other problems we've seen since the pandemic and that are not going away, then it became their worst nightmare, because inflation was in Main Street. They can't control inflation in Main Street, and that's self-evident. So all these problems are stacking up for them, and by them having to raise interest rates, forget what it actually does for a minute to the real economy. And I'm not dismissing that and trivializing it, far from it, but it's how it starts to impact the financial system, which is already creaking extremely badly and has been at times on and off since 2008. And that's something else at this point we can't quantify precisely what that will be. But I tweeted, was it yesterday, how JP Morgan's share price had fallen from 170, which was a high in October of 2021, and was down at 123 and had a low of about 118. We're talking their share price falling 29%, effectively from the high last October. Now, interestingly, quite often, for some bizarre reason, the initial reaction when they raised interest rates was to see the banks sort of move up 2-3%. And the argument seems to be, well, if interest rates rise, well, then banks can make more revenue from loans. But banks haven't been loaning money, been very reluctant to do so. Why are they going to want to suddenly loan more money to far more riskier propositions on the basis of all the things we've just discussed? And I don't see it to be something that actually is going to be hugely beneficial to the banks, given the profile of loaning anyway. Because it's one thing, Fed and Bank of England, etc., and ECB have been criticising banks for not loaning, and in many ways you can perfectly understand why you wouldn't want to. And this is why it's moved into shadow banking loans, and which is something that they've finally woken up to the reality that that's a huge problem in of itself. And I'll stop there, because frankly we could just keep talking about this for hours on end. But these are the kind of problems they're facing, and is raising interest rates 50 basis points going to resolve the inflationary problems? No, absolutely not from my perspective. And so therefore it'll be much of the same in 2 months, and we will track what happens with regards to equities, bond markets, etc. But I would expect the long end of the yield curve for treasuries to be dumped. But are they going to move into T-bills? I don't know. And there's no evidence at this point, but I would expect 10-year US Treasury the yield to move above 3%, and keep moving above 3%. Okay, I don't know what it will move to, and we're speculating here, because at the end of the day, there's always that issue of the Fed trying to suppress the yield curve. That's been self-evident for a considerable period of time. The fact they've sort of lost control of it and are not able to suppress it, and we've seen this flattening, as we said, from the 1 year almost through to the 30-year. Not exactly, but pretty much. Then, or should I say, the 2-year more on the 1 year? But it's not that different when you look at the differential between the 1 and the 30-year was about 35 basis points or something. It's nothing. So it's an interesting time. They finally had to bite the bullet. They never wanted to bite the bullet. And that's why they kept trying to kid themselves and kid the world that inflation was transitory, because in their mind, it was always going to be transitory, because they don't understand the concept of what's causing this inflation. They never expected it. And we're back to this point of their incompetency, their stupidity, and their inability to see things that for us is very real, is very obvious. It was obvious inflation was coming post sort of March 2020, but they never saw it because they just don't grasp or believe in this reality. And this is why in 2006 and 2007, when some of us were screaming at them, you're going to have a global financial crisis, and these are the reasons, the attitude was, no, that's not going to happen to us. If that only happens to Zimbabwe or somewhere else, their grasp on reality of what's unfolding is, to put it mildly, it's not even myopic, it's completely blind.
Yeah, I think it's the Keynesian paradigm where they stopped looking at money supply, which I think in the 80s a lot of people looked at. I remember last year, I think Jay Powell, who's actually trained as a lawyer, not an economist, he was asked in Congress by a congressman or congresswoman about M2, that it was growing really fast and whether that could result into inflation. And he said, oh, no, M2, it doesn't matter. It won't cause any inflation. But now we're seeing, that it does, because the growth in M2 is inflation. And what we're getting now is the rising prices. And I think that's what they don't understand. And it's something that I've tried to always emphasize here on my channel, that the central bankers, economists on Wall Street, City of London, they blame rising prices for inflation. They don't look at the creation of money and credit that's been through the roof since '08, and I think that's why they're kind of cornered now. And maybe you could touch upon what's happening here in the UK in terms of the Bank of England and the economy, and then after that we could look at a wild card that would be really, I would say, could really boomerang, like the Russian sanctions have boomeranged, and that's the possibility of China sanctions. So yeah, we'll start with the UK economy, if you don't mind.
Yeah, sure. I mean, obviously, you're right. They raised interest rates to 1% from by 25 basis points, or 0.25%. And yeah, you're absolutely right. The reaction to pound dollar was to knock it 2%. It's marginally back over 124 as we're speaking, but but I think it's the highest rate obviously since 2009. But in the context of going back in history, it's still ridiculously low. And then you're right, inflation's running, well, officially not sort of 10%, but in reality 20% plus. So again, it's wholly inadequate. But they are starting to admit and talk about recession, and it's the same problem that UK businesses are going to face. I mean, when we have spiking energy costs, the cost of everything increases, whether you're one of the few businesses in relative terms that actually manufactures and produces things. But in a service-based economy, if energy prices are rising, everything, your heating, lighting bills go up for starters. So this is extremely damaging for the UK economy, and as usual, governments, the Bank of England, and the circus don't acknowledge any of this. But UK business has been screaming since the pandemic about fears of this sort of inflationary problems, what it would do to UK businesses, how it's impacting businesses, how the risk and we've certainly seen a sharp increase in relative terms of insolvency and bankruptcies happening in the UK. And of course, it's the classic, as you start to get inflationary pressure, it kind of filters, and I hate using these terms, but if you look at the so-called working class people or people on lower incomes, some of them have already been having, since they removed the cap on in terms of energy costs, going, well, I have to make a decision between feeding myself, more importantly, feeding my children, and sometimes I may skip meals because I can't afford to feed myself and my children and my family, or, and then, okay, we've moved out the kind of autumn winter season for heating homes, but there's supposed to be more cap removed in October. What a great time of the year to do that, as we move it back into sort of autumn and winter. But the problem you're going to have for a lot of small businesses who would sell what are perceived to be luxury goods, this whole problem will start to permeate through the lower so-called working class people on lower incomes. It's going to move into the lower middle class band, the middle class, and so on. And it's going to start impacting them for all manner of different reasons. So if you sell luxury items as a small business or non-essential items, these businesses won't survive. And if you're starting to raise interest rates, then, and the general mood is, well, we're entering a recession, if the Bank of England come out and say this, you want to go and get a loan, you're going to struggle. You want to maybe you want to try and restructure your loan. Good luck with that. And if you can, you're not going to get it cheaper. You're going to pay more. And even in restructuring, okay, there's a big scramble now for people to try and get, sort of 5-10 year mortgages in the UK based on today. But the mortgage rates are going to rise. So people's cost of living crisis is inevitable for food, energy, rising interest rates. They're all catalysts for a serious problem that's going to affect large amounts of people, because once again, in the UK, rather like Europe and US, people are highly leveraged with enormous debt, and they're not going to be able to manage it. The risk is they'll lose their jobs. If they lose their job, what does that mean in terms of, are they going to risk losing their homes? Will they not be able to repay their mortgage? Do they face bankruptcy themselves? I mean, we have to take this seriously, and it's not something that's new to us, and certainly not from our perspective, Mario, and people listening, and in a broader context. But generally, the average person in the UK seems currently still oblivious. Apart from noticing that the cost of food's rising, they don't clearly understand, and that's not a criticism, where this is all leading. But again, it's one of those things that the Bank of England thinks, well, if we keep raising interest rates, it's going to curb inflation. But again, they don't understand what's causing the inflation. And it's almost like they're living in this textbook bubble of a reality and not comprehending what policy decisions were made in 2008 that were completely wrong, what they've done since then. And if your entire economy is driven by cheap credit, QE zero interest rate policy, and you start raising interest rates at what couldn't be a worse point in your economic financial cycle, given all the inflationary problems we're having, etc., then it couldn't possibly be a worse time. I mean, if you'd somehow magically had QE zero interest rate policy, but your economy was pretty stable, okay, we're moving into the realms of fiction here, but let's just use this for argument's sake. And then you started raising interest rates, there might be some way you can actually get around to some degree of being able to deal with this. But we know for a fact you just cannot do that. It's not reality. And they're now having to face their own dose of reality. And and ultimately, this is only going to be good for gold and silver, for me, from my perspective, because eventually the realization is going to be that all these fiat currencies are worthless. They're only backed by ludicrous monetary policy decisions. And this is why we're not going to go into the specifics of the Russian ruble, but the ruble is appreciated against the dollar and the euro, for example, simply on the basis that the world's going, well, this currency can actually be backed by Russian gold in eventually, or a basket of commodities. And why? Because the world's desperate for commodities. And who's got commodities in abundance? Russia. Not just energy, hard commodities, soft commodities, and therefore the world outside the West is waking up to the reality that the ruble in the future could be a currency utilized in international trade, because for precisely the reasons why the whole fiat monetary experiment's dying on its feet, and the idea that somehow the dollar is worth more than the yen and the pound, etc., and the euro is just farcical. It's that moment when there's a flip in the mindset that says, well, hang on, there's no point holding any of these currencies, fiat currencies. Where do I want to move to? Where can I have wealth preservation worse than a store of value? And obviously gold and silver are very clear indications of where that will happen. And that transition in mindset might be happening at a retail level, and has quite significantly. And in small ways, it's happening at an institutional high net worth level. But from what I understand, a lot of high net worth individuals are still going, well, what's the problem? The economy's okay. Look at the markets. There's no real issue. Yeah, there's a bit of inflation. It's transitory, but here's the problem they're going to experience. By the time they realize it's a problem, where are they exactly going to be able to source the demand for gold and silver that they want? They're going to be struggling because there's already a lack. If you want a ton of gold, you're not going to get it instantly. You might wait months. Well, there's suddenly a huge demand, and there isn't the supply. And anyone who's clever enough to understand that, for argument's sake, if gold was $2,500 tomorrow, that isn't necessarily a reason to sell it. The time to sell gold is when economies, financial systems have stabilized and assets are at the price they should be, in rather than in all these bubbles. And then it's the time to say, well, now's the time to have that store of wealth, that wealth preservation. And then you would then sell gold and buy assets in the real world again. But at the moment, we're far from that position. And it's not so much the price of gold in pounds or dollars that matters to me. It's its purchasing power in relation to buying an asset. So if you want to go and buy a house, and we've said this before, but it's worth reiterating. If a house costs £200,000 and an ounce of gold was £2,000, just to keep the math simple, you would buy it for 100 ounces. Is that fair value currently? Absolutely not from my perspective. But what happens if gold went to $5,000 an ounce, for argument's sake? And in pound terms, the house, because the housing market's a complete bubble, was suddenly worth 50% less in pound terms, and it was £100,000. Then you can buy the house for 20 ounces of gold. Now, there's your purchasing power. There's your store of wealth, and then you can buy assets. And at that point, if everything's stabilized, which at some point in the future it will be, then that's the time when holding gold and silver or maybe silver to a lesser extent because of the industrial application, because there's going to always be this never-ending shortage of silver. It's not going to go away because silver supplies globally are depreciating. But that's the time when it matters. And for me at the moment, I'm just looking at the price going, well, it's farcical, it's meaningless. Because for me, they're the most undervalued, and they're not assets, but for the point of conversation, it's an asset, but it's real money. But in dollar terms, and okay, they might be at an all-time high in terms of the pound or the yen or whatever, or approaching those. But for me, if we look at it in dollar terms, in no way, shape, or form is this representative of the price it should be. And they're the most undervalued assets in inverted commas globally. When you look at all the price inflation elsewhere that we've seen in commodities, it doesn't reflect it. But of course, it won't reflect it, because if gold was $2,500 an ounce, 3,000 tomorrow, you would see the biggest move out of dollars into physical gold, because that's the time when the high net worth individuals smell a problem. And they go, we need to get out of dollars or pounds, and we need to buy gold. And it's ironic, they don't buy it when it's cheap, because when it's cheap in their mind, there's no need to buy it. When it's more expensive, that's the time to buy it. That's the big difference with retail investors who see the correct flip side of the argument.
Yes, and the other thing about Russia, I would say, and the ruble, and I showed the chart of the ruble there, and it actually reached a a low. The dollar reached a low that we hadn't seen since before the pandemic. We touched 60 today, but I would say that Russia as well, fiscally, has very little debt. I think their debt to GDP is like 17%, and their external debt is like 37%. So aside from having all the natural resources, it's also got a handle on its finances, which makes the ruble a decent currency, I would say. So maybe now we could wrap up and talk about the prospect of maybe what's happened to Russia and the sanctions in the last few months. What would happen to the world economy? Not that it's doing great, as we saw earlier, when you spoke about the UK and the US economy, but what would happen to the world economy if something similar to what the West has done to Russia is done to China?
Yeah, well, there's a first point. Let's try and break this down. It's a fantastic question, and we'll try and condense it down because it's one of those we could again speak for hours about. There's a few points worth making first. And this again is this myopic view of the West. The West sees itself as the world. Now, as far as it's concerned, Southeast Asia or Asia, Central Asia, Africa, Central America, South America, they don't really exist. They're just these kind of provincial backwaters, and China's still like it was in the 1970s, Russia's like it was in the 1980s. But I mean, China has enormous markets in like the ASEAN nations. I mean, I won't go through the list of all the ASEAN nations, but it's enormous trading bloc you've got, which is the ASEAN, includes, of course, things like Vietnam, Thailand, etc. Then you've got the RCEP, which is the Regional Comprehensive Economic Partnership. That's a free trade agreement that came into being January the 1st of this year. That, of course, includes things like Malaysia, Myanmar, Japan, South Korea, China, Singapore, Thailand, Vietnam, etc. And what the West fails to realize is we'll come to why it's fatal for Europe and the United States to do this. But if they wanted to cut China off, for argument's sake, China's growing, trade is growing with the ASEAN nations. If you look in the first quarter of 2022, it totaled around 1.4 trillion yuan, so 200 and something billion dollars. That increased 8.5% year on year. That's just one example. When you look at China and Vietnam, in terms of the trade and what's in. I mean, often there's this idea that somehow China and Vietnam are kind of at war with each other. No, but it's about $230 billion equivalent, and the amount of cross-border freight trains between China and Vietnam has tripled since the beginning of this year. When you look at China's global trade, it totaled in the first quarter of 2022 around 9.5 trillion yuan, so 1.5 roughly trillion dollars equivalent. That's up 10.8% roughly year on year. When you look at the breakdown of that, the exports were up 13.5% to over 5 trillion yuan. Imports rose 7.5% to just over 4 trillion yuan. So you can do the maths, obviously, between the two. So that puts things in the context that there's this big world, and China's engaging not just with Asia or the ASEAN nations in the RCEP. You've got Central Asia, you've got the Middle East, you've got Africa, you've got Central America, South America, and then we can come on to the trade the EU has with China. And if you extrapolate back over the last decade or so, and you look at imports versus exports, and is obviously, unsurprisingly, the EU runs a deficit with China. Back about a decade ago, that was about 100 sort of billion euros. It's now in 2021 was about 260 billion euros. So the European Union is very dependent on China. And there's one point worth making here, that whilst Europe's struggling and is crippled by enormous hiking energy costs and largely most of it's suicidal by their own stupid policy decisions. The one thing China has and has considerably lower inflation, one of the reasons is because China sources energy. And like, for example, let's just keep the math simple. Let's say Europe currently wants to buy a barrel of oil and it costs them $100. The big difference is Russia will sell China or oil, gas, whatever, at a 35% discount. These spot prices don't apply. So China gets enormous amounts of its energy far cheaper. It buys huge amounts of energy from Iran at really big discounts. And therefore, you know, if it's energy based and its energy costs are much lower, it won't suffer from the same inflationary problems. So this is a big advantage for Europe, because Europe therefore will get Chinese goods a lot, you know, relatively cheaper. If China suddenly had really high energy costs, or they tried to sanction China, they can't buy the goods because no one else produces them. There's no other markets. I mean, if you want to transfer all China's production or exports to Europe, where are you going to provide these alternative markets? They don't exist, as the United States found to their stupidity with the trade war. The trade war completely blew up in their face, and we'll come on to China-US trade shortly. So there is no replacement. And the whole point is they still need these goods. They can't manufacture them themselves because they don't have the resource. I mean, and also, what are they going to do? Produce these goods with energy costs 30, 40, 50% higher, with labor costs 20, 30, 50, 70% higher? I mean, it's just economically and financially impossible. So they can't, and we've just explained the sheer size of China's trade with the European Union. In 2021, it grew 27% compared to the previous year. But there is this huge imbalance. But the other thing is, Europe would suddenly be cut off from trading with China. I mean, its exports to China are over about 230 billion euros. Well, we're saying that all suddenly just disappears, and the relationship between China and Germany is huge as well. I mean, China's Germany's largest trading partner in the European Union for the 6th year in a row. Italy's trade with China grew over 34% in 2021. And the big thing with regards to the issue of supply chains, when you look at obviously the exports from China to Europe, they're still growing, and China-European freight trains are not suffering the problems the ports have in terms of supply chain issues. They're arriving very timely. When you look by I think year-end China-Europe freight trains, there was over 70 routes reaching nearly 200 cities in 23 European countries, with maybe 50,000 different types of goods. And if you look at the number of China-European freight train trips, they rose about over 20% year on year in 2021. So there's enormous cooperation between China and Europe, as an example, in terms of tech, in terms of energy, in terms of digital economy, etc. And if you were to cut all that out, Europe thinks it's got problems which are self-inflicted largely with Russia. I mean, we've just explained in fairly simple terms, and there's a lot more detail behind that, why for Europe to sanction Russia would be total suicide. I mean, it's suicidal what they're doing with Russia in terms of energy, for example. I mean, Nord Stream 2 cancelling that was absurd, as we've said previously. So that's, you know, when it comes to just pure economic financial reality, you know, for Europe to do that would be suicidal. Now, when you come to the US and China, now the trade volume between China and the US in 2021 was over $750 billion. And that was up nearly 29% year on year. But obviously, again, there's this enormous trade imbalance between the United States and China. I mean, trade surplus in favor of China was nearly $400 billion for 2021. The irony is the trade war actually accelerated the trade surplus and did nothing. As we said before, and said many times before elsewhere, that the trade war Trump implemented was barking mad, frankly, and it's proved to be the case. But when you look at China's exports to the US since when they joined the WTO effectively, and you look at, you know, it's grown from around about 2000, 2001, it was about $75 billion. Okay, and then it grew steadily until obviously it was at around $400 billion prior to the pandemic. It fell off a cliff edge very briefly and went down to around 180 billion, and now it's well over 600 billion. And it's just grown exponentially, really, in the last 2 years. So again, that's because the United States needs cheap Chinese imports. And this idea the United States can bring its manufacturing base home, well, firstly, it doesn't have the infrastructure. Secondly, how is it going to compete with China? Because China will still sell to the rest of the world. The rest of the world won't sanction China. It can't compete on the basis that it has to pay Chinese wages to be competitive with China. Well, it can't do that simply on the basis that to have that cost metric in its economy and financial system would blow everything up. The other thing is if the United States, for argument's sake, could even do this, and it would take a decade, but say could magically do it overnight. The problem you have is the cost of living for everyone in the US would grow exponentially because they wouldn't be paying Chinese wages. And therefore, on that basis, the US might be able to have some sort of internal market which wouldn't function. And certainly in terms of its export, who's going to buy the US goods when who knows what, 50, 100% greater cost in terms of their exports, trying to sell the goods to the rest of the world that China's currently selling to the rest of the world. No one's going to buy the US goods. So, okay, we've sort of digressed slightly. But I'm trying to emphasize the point that the United States can't do this. And then we come on to, sorry, go on.
Oh, yeah, and it seems almost suicidal because like the Germans, for example, now they want to stop all oil exports from Russia into Europe, and they think they can change the supply chain of the oil coming from Russia in a matter of months. It just seems like crazy.
Yeah, you can't do it. It's impossible. And OPEC's come out and said, if you cut Russian oil supplies out of the market, do you know what you're going to do? Oil's going to go to $150, $200 a barrel. And if that happens, you blow the Western financial system up because of derivatives complex, never mind what it does economically. So, yeah, there's just no thought. And then another point worth making with regards to China. If you look in terms of foreign direct investment, mainland China, not offshore China, that attracted, well, around about $60 billion but around about 380 billion yuan. Now, it doesn't sound a lot, but that excludes foreign investment in banks, securities, etc. That inflow was an increase of 25% year on year. Now, is that going to diminish? Okay, the argument says if you cut them off, you might cut off the foreign direct investment, but Western institutions, Western companies are desperate to be part of the Chinese market. It's why in the first quarter of 2022, there was over 10,000 new non-Chinese enterprises established in China. If you want to go to China and set up a business in one of their free trade zones, so, yeah, and it's viable, they'll welcome you with open arms. So, and the other thing is this foreign investment desperately wants to be part of, because China is rotating its economy away from just producing cheap goods to being a high-tech global hub. So there's enormous investment coming into China in high-tech sectors. So with 50, 60, 80% increase in investment in high-tech industries, high-tech manufacturing, high-tech services. And, therefore, if you're going to cut these out the market, well, the investment could come from elsewhere. And therefore, the West begins to cut off its nose to spite its own face. And China's an entirely different ballgame, because people go, well, Russia's got all the resources. But China has resources, but China has access to resources. And because of the relationship with Russia and other nations, it can buy resources cheaper. So therefore, as we said, it can offset a lot of the inflationary pressure. And people say, well, China's inflationary figures are fictional, but they're not fictional. And inflation generally in large parts of Asia are considerably less, because also they don't have issues in terms of the transportation costs, the supply chain problems. If you go to Southeast Asia, they don't have supply chain problems. The policies of how they handle things during the pandemic were very different from the West. Inflation's often caused by food costs rather than services, and also the issue you have to reflect upon with regards to Asia is if you have significantly lower freight costs and supply chain issues, and also, let's be honest, the Iranians, the Middle East, the Russians, they'll all sell energy to these nations considerably cheaper. If you're on the friendly list, you're going to get all the benefits. If you're on the unfriendly list, we'll kill you with ridiculously priced contracts that is going to cripple your own economy. So there's a lot less inflationary pressure that exists. Now, okay, that might change in the future, but we have to deal with what we're seeing now. And they don't experience the problems that we're experiencing in the West. And therefore, on that basis, they're in a far better shape to handle what's going on and what's coming. And obviously, on that basis, that the West can't then just abandon these markets and say, well, we're not trading with China, because China could then turn around and obviously take severe retaliatory action as well. Not least in maybe they might just come out and say, we're back in the yuan with gold, which they could do. Yeah. They're in a position to be able to do that. And recall when people said, Russia can't back the ruble with gold. It's impossible. It's garbage. This is rubbish. Well, forget the gold price fix, which was an internal market issue. But the Kremlin's come out and said, look, we're considering pegging gold to the ruble. Basically what they're saying is we're considering, meaning we are going to at some point back the ruble with gold. And the West scratching its head, not understanding how that is even feasible, simply because it doesn't understand what that means. It doesn't understand that Russia has enormous gold reserves. And obviously this enormous commodity base, because it's led to believe that Russia's just this, what's it referred to, a gas station,
yeah,
with weapons,
yeah,
or with the military. Even though they think the military is useless, and now they're starting to learn,
that
that's not reality either. Yeah. So we've covered some points. There's a lot more detail to this, but that's a very high level overview of why. And trying to sanction China would be utterly suicidal, and also all it would do was make the global South go, well, we don't trade with Russia, with the United States or Europe. And the other thing is, it's the inward investment that China has made in Europe, in the United States already, in the UK. The amount of Chinese investment in the UK quietly is enormous, and it's growing enormously. And without that investment, there's a whole bunch of projects that would never get off the ground. They'd stall, they'd fail to materialize, which may actually have some hopeful beneficial impact on economies like in the UK going forward. So it would be a suicide mission, even though Russian sanctions are suicidal. This is like, you can't have suicide on steroids, but you kind of get my point, how much more serious a problem it would be to do so.
How likely do you think, how crazy do you think they are to do this? Do you think it's, what's the probability you think that this could happen? Because I've been noticing in a lot of mainstream publications, they've been talking a lot about that. Apparently last week, the US and the UK met to talk about China, and in China as well, they invited all the foreign and domestic financial institutions to look into this. Have you got a feeling of the probability that this could happen?
Well, let's be brutally honest about this. There is a risk of this happening for sure. I mean, we've talked about what's gone in Ukraine before and the antagonism which led to the Ukraine. Well, we're not getting into the discussion about what that's all about, because that's not what we're doing. But I'm using it to highlight that the same issues been going on in Taiwan. There's been US military advisor there providing Taiwan with military hardware and kind of trying to stoke this kind of separatist viewpoint that exists in Taiwan. But Taiwan and Ukraine are very different propositions. It doesn't have, apart from the fact it's an island, it's very much dependent on China for energy, etc. So I don't think the Chinese will be quite so magnanimous in terms of not blowing all infrastructure up and trying to avoid killing civilians if the worst came to the worst. But I think China would just for no reason launch a war against Taiwan? No. I mean, if they did, it would be ridiculous to consider it. Are they being threatened? Well, it goes far beyond Taiwan. There's that kind of US, UK, Australia bizarre trilateral pact. The US is trying to stoke tensions in the entire Southeast and convince everyone China's a threat to them. And so Japan's wobbling as Japan always wobbles. South Korea also is a risk. So there are far greater problems why, and a clear indication they're trying to antagonize China. No doubt about it. And principally, the whole point of trying to stoke tensions with Ukraine was to try and effectively either get Russia to completely back off and allow Ukraine to become part of NATO and all the other ensuing problems that exist there. But Russia was never going to do that. But what they were hoping is clearly, if we subjugate Russia, we'll have Putin removed, which is never going to happen. We'll destroy the Russian economy and financial system. That's not going to happen. And Russia will have to leave. They'll lose the war. It'll be maximum humiliation. We'll crush Russia. And if we crush Russia, then the multipolar world's dead because China can't do it on its own. It's the China and Russia combination that makes both those nations such a threat from the US perspective, because they have the ability to create a whole multipolar world, which is already long since in existence and is in a pretty, not advanced, but fairly significant progress in terms of its maturity. And so the argument is, well, it's not really working with Russia, but we'll keep pegging away because we might just achieve our objective. If we can keep financing this war, we'll eventually bog Russia down and they'll lose and Putin will be gone. But that's just their delusional mindset. So therefore, the plan might be, well, plan B is, well, we're not really it's not working with Russia. So let's see if we can crush China instead, because if we crush China, then Russia will just crawl back under its shell. It'll leave Ukraine. It will say, do whatever you like, the West. You can, I don't care if NATO's in Belarus, we'll toe the line and behave ourselves. So they could go for that maneuver because they're not succeeding with Russia. Is it possible? Yes. Are they insane enough to try and do it? Yes, but as much as the insanity exists in the Beltway, there are enough cooler, sensible heads, even inside the intelligence services and, for that matter, the Pentagon, who understand the consequences of what this might be, because China won't take the same attitude as Russia. There's no doubt they would do that. If their backs are against the wall, then they would deal with things in a far more clinical way and say, we don't care what the world thinks about this. If you're thinking you're going to come in and try and destroy us as a nation, and China knows they're under attack. They know the risk of potentially of sanctions because, as we've said before, as insane a policy as it would be for Europe and the United States and the UK to do this, they haven't learned a lesson from the sanctions on Russia and what the consequences are and will continue to be. So equally, they're going to be completely blinded to the reality of what doing it to China will be. But in a roundabout way, we're in that phase where this is kind of, we've had the long ongoing World War III economically and financially, but in essence, this is kind of, it is a proxy war between Russia and the US and NATO, but in a roundabout way, not least supplying arms to them and intelligence, etc., etc. And by extension, you could say that the United States, I'm not quite sure how Europe would feel about this with China. And that might be why they're trying to gather some ramshackle alliance in the Far East to try and support them in their initiative. But the US is desperate. The reason Ukraine is what it is and Taiwan potentially is what it is because the US knows Germany's dying. It knows the dollar's dying. It knows its reign as so-called superpowers has come to an end, that the world's turned its back on them. I mean, you have to see developments since the Ukraine war with the Middle East as just one example. So it's desperate. It's desperate to try and regain its hegemony and its unipolarity, even though it's dead. And so, desperate times can make desperate, insane people do ludicrously insane things. So we can't rule it out. How likely is it? I wouldn't say it was likely, but it's a realistic possibility. And the longer the Ukraine war goes on, and it's self-evident the US is, or Ukraine isn't winning and Russia is. Now, could that change? Yes, of course it could. But it's unlikely at this point in time. Then the desperation inside Washington will continue to grow, and that's why it's trying to seek an alliance. And it thinks, well, we encircled Russia via NATO, and after promising not to extend NATO east, they did. But the converse thing now is that they're going, well, we need to try and contain China. There was the Quad Alliance, which has really blown up in their face. There's this US, Australia, UK trilateral pact trying to drag Japan into that. They're trying to create massive hostilities between Japan and China, and Japan being the dutiful vassal state that's committing suicide, not least with what's going on with the yen. They'll happily acquiesce to US demands and not realizing the consequences for Japan in the short and medium and long term. But of course, they never think like that because they're in the camp that thinks the US will always reign supreme. It's like Europe has this delusional mindset, as does the UK, that, that somehow we are the world, we will triumph, we will succeed, and not looking at the reality of what's unfolding and going, well, actually, the so-called global south, 88% of the world's population. They are massive vertical growth centers. They are the future. That's where all the major growth is going to happen. They're not saddled with all the insane financial and economic policies we've made, and they're very low-cost centers, et cetera, and they are the future. And the West just won't grasp this because, as far as they're concerned, they are, and that's why you have lunatics inside Brussels who are making all these grandiose statements about how, you know, we're going to crush Russia, how we're going to control the narrative in terms of we're going to be the ones. And they're even trying to upstage the Americans in terms of sanctions. What I do understand, and has been said to me, is even the United States is looking at certain European policies going, are they seriously wanting to implement an oil embargo on Russia? Do they not understand the consequences? But there is some deep-seated hatred inside Brussels that is blinding them to the reality of the just foolish and worse, you know, decisions they're making with respect to Russia. But when you're blinded by hatred, then, you know, people lose all perspective on reality and the things they should be doing, as opposed to the policy decision they are actually implementing. So it's very complicated, but given how insane the West has behaved with regards to the Ukraine war and Russia, then yeah, we can't rule it out. We shouldn't dismiss it as unlikely as it should seem if we're talking about this objectively. But since when in Western politics do we, and, you know, governments, when do they ever make rational decisions? They just make decisions on the basis that they're completely inept. They have no grasp on reality. They don't understand what's happening in the world. They didn't understand why 2008 happened, why we're in the mess we're in now. They don't understand in a broader context that all their policies and aggression towards China and Russia are self-inflicting wounds. They're, you know, it's death by 1,000 cuts. And how many cuts have they had already? 900. I mean, so never rule anything out.
Great. Paul, thank you very much for your time. I appreciate it.
Oh, it's a pleasure as ever, and thank you.
Yeah.
And hats off to you. You do a great job as well, and everyone should support you. And I make a big point of telling people I know to follow you on your YouTube channel and list, because you have a very calm delivery, but you say some really great things and you emphasize the reality, and you talk as someone who's worked in the financial sector, who knows and understands the reality, as opposed to, dare I say it, the whole bunch of charlatans out there who've never worked in the financial sector. And you can see by the way they talk, they're just faking it and pretending they do. And you're the genuine article, and everything you say proves that eloquently. So hats off to you as well.
Thank you very much. And we'll talk later. Take care.
Yes, all the best.